Imagine two identical twins, both 25 years old, both earning exactly $75,000 a year. They both discover ETF investing on the same day and decide to invest the same amount every month for the next 40 years. Fast forward 4 decades later, and here's the shocking reality. Twin A has accumulated $800,000, while Twin B sits on a massive $1.3 million portfolio. What created this $500,000 difference? It wasn't luck, it wasn't timing the market, and it wasn't picking better ETFs. The difference came down to a single 5-minute decision about where they chose to invest their ETFs. Today, I'm going to show you exactly how this one choice could be the difference between a comfortable retirement and true financial freedom. Drop a like if you're ready to join the smart money crowd, and subscribe to become part of a community that chooses wealth over wishful thinking. Let me tell you about Alex, a 28-year-old software engineer who just had this exact realization. Alex makes $85,000 a year, and after months of research, finally understands that ETF investing is the path to wealth. Alex has got $10,000 sitting in a checking account, ready to invest in VOO, the S&P 500 ETF that tracks America's top 500 companies. But here's where Alex hits a wall that most new investors never see coming. The broker presents 3 different account options, and Alex has no idea which one to choose. This isn't just about convenience or fees. This single decision will determine whether Alex pays over $200,000 in unnecessary taxes over a lifetime, or whether Alex gets to keep every penny of investment growth. The crazy part? Most people make this choice in 30 seconds without understanding the massive consequences. Don't be like most people. Alex is standing at a crossroads with 3 distinct paths ahead. The first path is the brokerage account, which promises immediate access to money whenever needed. The second path is the traditional IRA, a mysterious tax delay chamber that offers immediate tax benefits but with strings attached. The third path is the Roth IRA, what I call the tax freedom vault, where you pay up front but potentially never pay taxes again. Each path leads to a completely different financial destination, and once Alex starts down one path, changing course becomes expensive and complicated. Most financial advisors will give you a generic answer about diversifying across all 3, but that's not what wealthy people do. Wealthy people understand that your age, income level, and timeline should drive you toward one primary strategy. Let's follow Alex down each path and see exactly where each leads so you can make the smartest choice for your situation. Path 1. The brokerage account. Alex decides to start with what seems like the safest option, a regular brokerage account. Alex invests the $10,000 in VOO and continues adding $500 every month. By the end of year 1, the portfolio has grown to $11,200, giving a nice $600 profit. Then tax season arrives, and Alex discovers the first costly lesson. That $600 profit gets taxed as a capital gain, costing $150 in taxes. The thought is, well, $150 isn't that bad for a $600 gain. But this is just the beginning. Every year as the portfolio grows and Alex rebalances or takes some profits, there are more tax hits. By year 5, when a medical emergency forces a $5,000 withdrawal, Alex is grateful for the instant access with no penalties. This flexibility saves from going into debt, and Alex realizes this is the brokerage account's superpower: total liquidity. Fast forward to year 15, and Alex's brokerage account is worth $180,000. Not bad, right? But here's the hidden cost never calculated: over $15,000 paid in taxes along the way. These taxes didn't just disappear. They represented money that could have been compounding and growing for 15 years. The brokerage account gave flexibility and peace of mind, making it perfect for emergency funds and short-term goals like saving for a house down payment. But for long-term wealth building, those taxes are eating into compound growth every single year. Path 2. The traditional IRA. Now let's rewind and see what happens when Alex chooses the traditional IRA path. Alex invests the same $10,000 initially and contributes $7,000 annually, which is the current IRA contribution limit for 2025. Here's where the magic starts. When tax season arrives, Alex discovers that the $7,000 contribution has reduced taxable income from $85,000 down to $78,000. Since Alex is in the 22% tax bracket, this saves $1,540 in taxes immediately. Alex feels like getting a $1,540 bonus from the government for investing in the future. Year after year, Alex continues this pattern, getting immediate tax relief while the money grows completely tax-free inside the account. There's no annual tax on gains, no tax on dividends, nothing. The money compounds without the government taking a cut every year. After 30 years of this strategy, Alex's traditional IRA is worth approximately $900,000. Alex has saved tens of thousands in taxes over the decades and watched the money grow uninterrupted. But here comes the catch that many people forget about. When Alex turns 65 and starts withdrawing money for retirement, every single dollar taken out gets taxed as regular income. If Alex withdraws $50,000 in the first year of retirement, that $50,000 gets added to any other income and taxed at whatever rate applies then. The traditional IRA was essentially a deal with the government. They let Alex skip taxes now in exchange for paying taxes later. The bet Alex made was being in a lower tax bracket in retirement than during working years. For many people, this bet pays off, especially high earners who expect their retirement income to be significantly lower than their peak earning years. Path 3. The Roth IRA. Now let's see what happens when Alex chooses the Roth IRA path, which is completely different from everything we've discussed so far. Alex invests the same amounts, $10,000 initially and $7,000 annually, but this time gets no immediate tax break. When Alex earns $85,000 and contributes $7,000 to the Roth IRA, Alex still pays taxes on the full $85,000. This feels painful at first because Alex is paying $1,540 more in taxes every year compared to the traditional IRA option. But here's where the Roth IRA becomes absolutely magical. That money grows inside the account completely tax-free, just like the traditional IRA. But with one crucial difference. When Alex starts taking money out in retirement, Alex pays zero taxes. Not reduced taxes, not deferred taxes, zero taxes forever. Let's run the numbers to see why this is so powerful. After 30 years, assuming the same 10% average annual return that the S&P 500 has historically provided, Alex's Roth IRA grows to approximately $1.3 million. Of that $1.3 million, only $220,000 came from Alex's actual contributions. $10,000 initial plus $7,000 times 30 years. The other $1.1 million came from compound growth, and Alex will never pay a penny of tax on any of it. If Alex were in a 25% tax bracket during retirement, the traditional IRA would cost about $275,000 in taxes on that same growth. The Roth IRA just saved Alex nearly $275,000. Here's the part that makes the Roth IRA even more powerful. There are no required minimum distributions. Traditional IRAs force you to start taking money out at age 73, whether you need it or not, and you pay taxes on every withdrawal. With a Roth IRA, Alex can let that money keep growing for as long as Alex wants, potentially leaving a massive tax-free inheritance to Alex's children. The Roth IRA isn't just a retirement account, it's a generational wealth-building tool. Now here's the part that most financial advisors won't tell you, but it's crucial for making the right decision. We need to talk about where tax rates are headed in this country, because this affects whether the traditional IRA or Roth IRA will be better for you. Let's look at some uncomfortable facts about America's financial situation. Our national debt has exploded past $33 trillion and continues growing every day. The COVID pandemic added trillions more in spending. And we have massive infrastructure needs, an aging population requiring more healthcare and social security, and ongoing international obligations. There are only three ways for the government to handle this: cut spending dramatically, print more money and create inflation, or raise taxes. Historically, raising taxes has been the most politically palatable option. If you look at U.S. tax history, our current rates are actually relatively low compared to previous decades. In the 1950s and 1960s, the top marginal tax rate was over 90%. Even in the 1970s and 1980s, rates were significantly higher than today. When you look at other developed countries that have been around longer, many have tax rates in the 40% to 50% range. The uncomfortable truth is that tax rates in America will likely increase over the next 20 to 30 years. This is why the Roth IRA becomes even more attractive for younger investors. Alex is essentially locking in today's relatively low tax rates and protecting against whatever tax environment exists in 30 years. Alex is paying 22% now to avoid potentially paying 35% or 40% later. This tax rate arbitrage could end up being worth hundreds of thousands of dollars over Alex's lifetime. Here's where Alex gets really smart about strategy, and this is what separates wealthy investors from everyone else. Alex realizes that choosing just one account type isn't necessary. The optimal strategy often involves using multiple account types strategically. Alex develops a three-tier approach that maximizes financial flexibility and minimizes lifetime tax burden. First, Alex keeps 3 to 6 months of expenses in a regular brokerage account as an emergency fund. This money is invested in stable, liquid ETFs that can be accessed immediately without penalties if life throws a curveball. This gives the peace of mind that comes with liquidity while still earning better returns than a traditional savings account. Second, Alex maximizes Roth IRA contributions every year, currently $7,000 annually. This is the long-term wealth-building engine, designed to compound tax-free for decades. Since Alex is young and expects to earn more money as their career progresses, Alex is betting that paying taxes now at 22% is better than paying them later at potentially much higher rates. Third, if Alex's employer offers a 401k with matching contributions, Alex contributes enough to get the full match, which is essentially free money. If the employer matches 50% of contributions up to 6% of salary, Alex contributes at least 6% to capture that full match. Depending on current tax situation, Alex might choose traditional 401k contributions for the immediate tax break or Roth 401k contributions for the long-term tax advantages. This diversified approach gives Alex tax flexibility in retirement. Alex can withdraw from the brokerage account without any tax consequences since Alex already paid taxes on that money. Alex can withdraw from Roth accounts completely tax-free. And Alex can strategically withdraw from traditional retirement accounts to fill up lower tax brackets. This tax diversification is like having multiple tools in a toolbox, each perfect for different situations. Alex's final strategy: $7,000 emergency fund in brokerage, $7,000 in Roth IRA for long-term growth, employer 401k match maximization. Let's circle back to Alex's transformation. Alex started this journey confused and overwhelmed by the different account options, not understanding that this single decision would impact the financial future more than almost any other choice possible. Alex now has a clear, strategic approach that positions Alex to accumulate over $1.3 million by retirement age, compared to the $800,000 Alex might have had with a less optimal strategy. But here's the most important part of Alex's story. Alex started taking action immediately. Alex didn't spend months paralyzed by analysis, trying to predict exactly what tax rates would be in 30 years or attempting to time the perfect market entry point. Alex understood that time in the market beats timing the market every single time, and that the power of compound interest rewards those who start early, not those who wait for perfect conditions. Your assignment right now is this: calculate your own 30-year projection using the account strategy that makes the most sense for your current situation. If you're young and in a relatively low tax bracket, the Roth IRA is probably your best friend. If you're a high earner looking for immediate tax relief, the traditional IRA might be your starting point. If you need flexibility and liquidity, don't ignore the value of a taxable brokerage account. The most important thing is to start, even if it's just $100, to test the waters and get comfortable with the process. Remember, the best time to plant a tree was 20 years ago, but the second best time is today. Your future self will thank you for making this decision now rather than waiting for someday. Which account will you choose? And more importantly, when will you start? The clock is ticking, and compound interest is waiting for no one. If Alex's transformation inspired you to take control of your financial future, show me by hitting that like button. Drop a comment telling me which account strategy you're choosing: brokerage, traditional IRA, or Roth IRA. And subscribe so you never miss the wealth-building strategies that could add millions to your retirement. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.